Greetings and welcome to the Neuberger Berman Private Markets Academy. I'm Ross David, National Sales Manager within our client coverage team, and I'll be your host. Our first module is focused on private equity co-investments. Co-investments, also known as direct deal buyouts, continue to be high in demand because of the diverse benefits they offer investors, or LPs, and private equity managers, or GPs. Let's talk about why. A recent Goldman Sachs survey revealed that nearly 60% of limited partners, or LPs, plan to increase their co-investment allocations in the next 3 years, significantly more than other private market strategies. Private equity managers, or GPs, have increasingly leaned towards co-investments to execute transactions, particularly in the middle market space. Of all middle market PE deals finalized in 2023 with valuations of $500 million or less, co-investors participated in a whopping 86% of them. Larger institutional investors such as sovereign wealth funds, pension funds, and family offices generally drive most of the activity. However, in recent years, interest has grown among individual investors. Globally, more than 1/3 of individual investors are interested in private investments, ranking them just behind financial planning, retirement income planning, and sustainable investing as the capabilities they seek most often from their advisors. Co-investments have gained in popularity due to their ability to offer direct access to private companies and their potential to provide lower fees, enhanced returns, greater control, and diversification benefits for investors. Co-investments are typically made alongside a private equity GP, often with no fee or carry on that underlying deal, depending on the strength of the relationship. When comparing an investment into a single GP private equity fund versus a diversified portfolio of co-investments across PE or GP sponsors, an investment into a single GP solution is typically 2 and 20, 2% annual management fee and 20% carry on underlying deals, while a diversified portfolio of co-investments from multiple GP sponsors typically has a lower annual fee and carry rate. So, a co-investment portfolio provides access to multiple private equity GPs into deals in their area of expertise in a more diversified, but importantly, more fee-efficient way. However, co-investments require higher levels of expertise, risk management, and a deep network to source best-in-class opportunities. Picking the right deal to invest in and the right co-investment partner is paramount, which is why you're here, and we're glad you are. In developing this module, we had 3 goals in mind. First, educate you on the most important elements of co-investing. Then, to elevate your knowledge on how adding co-investments to your clients' portfolios can help enhance diversification and performance. And finally, to empower you by showing you how to implement co-investments in your client portfolios. Here's how we'll tackle co-investments. Each chapter will be approximately 10 minutes and include deep dives focused on answering the following questions on co-investments. What co-investments are and how they work, why investors add them to their portfolios, how a deal gets done from start to finish, and we'll finish by sharing how investors can access co-investments. So without any further ado, let's begin with our first question. What are co-investments and how do they work? To address this, I'd like to introduce Luke Mason, a principal on the Neuberger Berman Private Markets Investment Team.
Hi, my name's Luke Mason, and I'm a member of the private equity team at Neuberger Berman, based in London. In this course, I'll be walking you through an introduction to co-investments by covering what they are and how they work. At the highest level, co-investments provide a way for investors to allocate their money directly into a specific private company. That is, a company not listed on a public exchange. They do this alongside a private equity firm or manager, otherwise known as the lead sponsor or general partner, GP for short. To keep it simple, I'll use the term lead sponsor throughout this course. The lead sponsor typically owns or plans to own the company and has responsibilities for its management and oversight. Here's a quick example of how a co-investment might work. Let's say a lead sponsor would like to purchase target company A, but the company is valued at $400 million, and they are limited to investing only $250 million due to available capital. The lead sponsor can seek out other investors such as another private equity manager, but this means they may have to give up control. Another option is to seek other investors known as co-investors that can help them bridge the remaining $150 million. In this scenario, the lead sponsor maintains control, the co-investors receive minority interest, and the $150 million becomes the co-investment capital. Co-investing has many dimensions, but perhaps its most distinct and valued feature is that it allows investors to put their money directly into a specific company or deal. In this sense, co-investments are equivalent to direct buyout deals. Co-investors generally assume passive roles as minority investors. However, the level and depth of interaction or involvement with the lead sponsor can vary depending on the co-investor's level of expertise and objectives. Another dimension to co-investing worth mentioning is that it involves a high degree of complexity versus investing in funds. Getting deals done is not easy. It requires specialised skills, teamwork, accuracy, and speed throughout each of the key stages of the process. We frequently get asked why lead sponsors offer high-quality co-investment opportunities in the first place, with the presumption being that they would keep the most promising opportunities for themselves. So, what is in it for the lead sponsor? Lead sponsors may have many reasons for offering co-investment opportunities to specific partners, chief among them being the need for capital from external sources to complete the transaction. Some might have a restriction on what percentage they can invest into a single company, industry, or geography, or they may not want to fund a deal completely so that they can invest in more opportunities to properly diversify their portfolio. Co-investors help to fill the gap in both cases. For many lead sponsors, it is vital to expand their relationship network to build a strong stable of knowledgeable and experienced co-investors who can help support them during the co-investment process. Longer term, the lead sponsor hopes to be able to confidently call upon these investors not only for more co-investment capital, but also potential capital for their other strategies. Co-investments also allow investors to become more familiar with and to better understand the lead sponsor's investment process. This in turn can make investors more comfortable with the lead sponsor and again, increase the likelihood that they would want to work with them on future transactions. Now that we have covered what a co-investment is and why they exist, I'd like to now focus on the different types of co-investment that are available. The type of co-investment you participate in can vary depending on the point at which you get involved in the life cycle of a specific deal. At Neuberger Berman, we believe there are three types of co-investment. Number one, traditional, also known as syndicated co-investments. Number two, co-underwrite or pre-syndicated deals. And three, midlife co-investments. In order to understand the different types of co-investments, it's important first to understand the timeline of a co-investment. The first step is for the opportunity to surface, as the lead sponsor identifies a company it may want to purchase. This is known as the origination or sourcing stage. The next step is for the lead sponsor to conduct due diligence to determine if the company is worth the investment. This assessment is based on a variety of factors, including, but not limited to, price, market size and growth potential, competitive positioning, growth drivers, the management team quality, and financial performance. Once the lead sponsor has determined that it does in fact want to make an investment, it will then begin the execution phase, during which they may need to seek co-investors to complete the deal. This is where a traditional or syndicated co-investment comes into play. Most investors participate in traditional co-investment arrangements, which account for the majority of total transactions. Here, lead sponsors seek co-investors typically after the deal is signed or already closed to offer a co-investment opportunity, and as the name suggests, syndicate the opportunity. Co-investors in these deals get in at a point in the timeline when there's very little scope for change. lead sponsors will generally offer these opportunities to investors that are pre-existing investors in their primary funds, are modestly sized, and that can make quick and firm commitments. With co-underwrite or pre-syndication deals, lead sponsors partner with co-investors earlier in the transaction, typically before a purchase agreement has been signed. These opportunities are provided to a limited number of co-investment partners who not only have the qualities the firm seeks in traditional co-investors, but often others as well. In these type of transactions, lead sponsors are looking for capable investors who can step in and work alongside their teams by performing their own due diligence, offering insights and views on the business and the broader market, as well as helping to determine the optimal valuation for the portfolio company. These co-investors are deeply involved in due diligence and likely have the ability to assume a larger investment stake than other investors. They also have more influence than co-investors in a traditional or syndicated transaction, and there is some underwriting risk the co-investor takes on, for example, being responsible for deal expenses if a transaction falls through. Capital is critical for the deal's completion, and thus lead sponsors will generally only work with co-investors they trust and know well. The challenge with co-underwrite pre-syndication deals is that there are few co-investors that tick all the boxes and have the resources, expertise, and experiences required. For the co-investor, these types of deals provide additional potential benefits beyond a traditional co-investment. For example, co-underwrite transactions allow the co-investor to learn more about the target company over a longer period of time, given the co-investor works alongside the lead sponsor in conducting due diligence on companies as well as structuring and execution. Last but not least are midlife deals. To understand these type of co-investments, we'll need to extend our co-investment timeline a bit. In the normal course of a private equity transaction, once a lead sponsor has purchased a company, it will execute on its value creation plan, which, as mentioned previously, are those key strategic and operational actions aimed at improving earnings growth and the overall worth of the company. Sometimes, after a few years, the lead sponsor may need to look for additional capital to invest in the company, which can be used to fund add-on acquisitions, recapitalizations, or some other action aimed at helping to increase the value of the company. And this is where midlife co-investments come into play. As their name suggests, these are transactions where investors enter the process later. With a midlife deal, there is generally a bilateral discussion between the lead sponsor and co-investor on how diligence will be performed and how the transaction will be documented. There are many benefits of entering a midlife co-investment, including a generally less competitive process, moderated valuations, mitigated risk due to the lead sponsor's familiarity with the company, and the potential for early realizations or exit, given the lead sponsor has already held the asset for some time. Regardless of the type of co-investment deal, the process of executing a transaction from sourcing all the way to exit, as well as how the lead sponsor actually creates value within the investment, is crucial to understanding and becoming a successful co-investor. Being able to execute on co-investment successfully requires a lot of resources and expertise, as well as the ability to act quickly and have capital readily available. Because this is very difficult, many investors who want to access co-investments opt to invest in private equity managers who can execute co-investments on their behalf. These private equity managers, or what we will call co-investment managers, generally also have the benefit of investing in companies across various lead sponsors. Whether you're looking to do co-investment yourself or seeking to partner with co-investment managers, there are three factors that play vital roles in determining success. First, the ability to source deals. Second is the ability to conduct in-depth due diligence on both the lead sponsor and underlying portfolio company. And finally is the ability to execute and create value on behalf of the underlying investors. Let's get into each in detail. The first stage is all about sourcing and maximizing the breadth, quality, and consistency of deal flow. investors want to engage with co-investment managers who have access to a range of lead sponsors who are able to offer consistent deal flow and a variety of co-investment transactions from across the market as outlined above. As explained before, good co-investors build strong relationships with lead sponsors by being a good partner. This can include having readily access to capital, providing some sort of value add, perhaps the ability to offer independent research or conduct in-depth due diligence on a particular opportunity, and finally, making fast and efficient decisions. Here we have some typical questions to help gauge whether or not a co-investment manager has the sourcing capability needed for co-investing. The second stage is characterized by extensive due diligence, most often led by experienced co-investment professionals who analyze opportunities and share their findings. An important note here for investors considering co-investment is that there is a dual responsibility to research the lead sponsor, including their team, investment strengths and ability, and long-term track record in generating value in the companies they have held, as well as the company being purchased, which can include its products, market positioning, and industry dynamics. The final stage focuses on deal execution and the myriad of details involved in the final run-up before the investment is made. This is the point where terms are negotiated and finalised, tax structures are analysed, governance roles are established, and all the I's and T's have been dotted and crossed in the massive amounts of legal documentation required. Alignment of interest is particularly important to understand and implement properly in this step of the process. One thing to keep in mind throughout the process is how important it is as a co-investor to be efficient, communicative, and decisive. Deals are almost always offered under tight deadlines, and with so many moving parts and different skills required, co-investors need to be nimble, or promising opportunities can vanish as quickly as they surface. Being able to say yes or sometimes no is extremely important. This underscores why choosing your partner and fully understanding their capabilities and expectations is so critical. The process is challenging and teamwork is essential. Before we conclude, I know we have shared a lot of information, so I wanted to go over some key takeaways when thinking about co-investing. Co-investments are direct investments into a private company alongside a private equity firm or lead sponsor that will then manage the company's growth and development. Lead sponsors who need co-investment capital to complete deals will also look to leverage co-investments to deepen relationships with their investors. There are three types of co-investments: traditional or syndicated, co-underwrite or pre-syndication, and midlife. The latter two are more complex, and co-investors need specific skill sets to execute, but they can provide additional potential benefits. Last, due to the resource-intensive nature of co-investments, selecting the right co-investment manager is crucial. The goal should be to partner with someone with a deep network that can source and provide high number of attractive opportunities, and that has the ability to conduct the extensive due diligence necessary to generate consistent returns over time.
Now that you've become more familiar with what a co-investment is, we'd like to continue with the educate portion of our co-investment module and talk about the growing demand for this strategy from investors and the drivers behind it. Some key tailwinds make the climate more conducive to co-investments. For example, market trends such as active deal markets, rates at elevated levels, and more difficult or expensive access to debt all can contribute to the appeal of co-investments. However, even in periods where conditions are not ideal, there are always pockets of co-investment opportunities. For example, a slowdown in overall exit activity may allow midlife co-investments to shine due to their ability to provide steady liquidity to private equity firms when they can't find it via IPOs or other usual exit paths. As such, it's important to understand the benefits of co-investments and how they can help improve a portfolio's overall risk-return profile across various market environments. Our next speaker is Jackie Wang. Managing Director on the NB Private Markets investment team, who will address the question, what are the benefits of co-investments? Or what value do co-investments bring to a portfolio? And why should they be included?
Hello, my name is Jackie Wang, and I'm a Managing Director on Neuberger Berman's Private Markets investment team based out of New York. The demand for co-investment continues to grow and has become an important part of the private equity landscape as a source of capital for private equity transactions, as well as within private equity portfolios for investors. Initially, investors in co-investments were mostly concentrated among institutional investors like pension funds, endowments, foundations, and sovereign wealth funds. Today, however, the universe includes a broader range of interested investors, including family offices, RIAs, and individual investors. Why are co-investments so appealing to investors? And why do many now consider them to be a core part of their private equity portfolios? In this video, I plan on answering that question by first starting with some of the primary reasons why investors may look more closely at co-investments. And then we'll discuss how co-investments can fit into an overall portfolio. The most often cited benefit for co-investments is the potential for attractive risk-adjusted returns. Now, this potential is driven by two sources. First, co-investments allow investors to access direct private equity investments in a fee-efficient manner. A co-investment is typically offered to a limited partner with no management fee or carried interest, which reduces the fee burden, often seen within private equity. If investing through a fund, a co-investment fund generally charges lower fees than a traditional buyout fund. Second, a co-investment portfolio can lower risk through the benefit of diversification. A co-investment fund, or for investors with a large and strong network of GP relationships, co-investments provide the opportunity to build a diversified portfolio of direct private equity investments across industries, enterprise value, value creation initiatives, private equity sponsors, and geography to enhance returns. For investors who have access to direct co-investments, another benefit of co-investments is that they allow for more flexible and tactical portfolio construction and can be complementary to existing private equity portfolios. When making a primary fund commitment, the investment decision and deployment pace of the fund is at the full discretion of the private equity manager. With co-investments, an investor has the opportunity to increase allocation to certain sectors and be tactical. For example, if an investor would like to over-allocate to enterprise software, they can increase exposure through co-investments. The flexibility of co-investing allows investors to be more strategic and targeted in the process of building and developing private equity portfolios. Another key benefit to co-investments is that relative to fund investing, capital deployment can be quicker. By investing directly into a portfolio company, your capital is invested immediately. This ability to put capital to work immediately reduces the J-curve. I'll explain more about this later. Another advantage of co-investing is that it can enhance the relationship with GP partners. Co-investments provide a valuable chance to work with leading GPs in a more collaborative capacity. This ultimately helps deepen relationship networks, which are incredibly valuable in private equity and can lead to greater access to the private equity firms for future opportunities. It also allows investors to increase their exposure to key top-tier existing managers. Those are some of the benefits of co-investments, and they are compelling. But there are also risks to consider. First, a co-investment comes with greater risk than a fund investment, given its focus on a single company, and as a result, greater investment concentration. A buyout fund may invest to 10 to 20 plus portfolio companies and hence greater diversification. Second, evaluating and executing co-investment transactions come with high degree of complexity. It requires a broad network of GP relationships to source the transactions and a team with the skill set to evaluate investment opportunities on often tight timelines. This also leads to the third consideration for co-investments. For those doing it themselves, it is highly resource intensive. Co-investments absorb significant time and resources given their complexity. The process of networking and creating a large pipeline of quality opportunities and the extensive evaluation required. Knowing what is involved before committing is critical. Because of these considerations, investors who do not have the resources to source or evaluate co-investments often consider a co-investment fund. A co-investment fund managed by an experienced private equity manager will have a large and experienced private equity platform to source, execute, and build a diversified portfolio of co-investments. One way to see how co-investments can be an efficient portfolio building tool is to compare it to other types of investments. For this, we will show a co-investment fund compared to a traditional direct buyout fund compared to a fund of funds. As you know, a co-investment fund is a portfolio of direct private equity investments alongside various high-quality private equity firms. A traditional direct buyout fund, which is a portfolio of direct investments with a single GP. A fund of funds is a portfolio of private equity fund investments. Now, in terms of diversification, a fund of funds will offer the most, given that it invests in multiple private equity funds, which will result in gaining exposure into hundreds of companies. A single manager fund will have the least diversification in that the lead sponsor is the same across all deals. A co-investment fund will have greater diversification than a single buyout fund, as well as diversification by GP. Some may confuse co-investment funds with being a fund of funds, and therefore being expensive and not fee efficient. However, this is not accurate, as co-investments is a fee-efficient way for investors to access private equity. Co-investments are typically offered to their limited partners with no management fees or carried interest. Co-investment funds generally also charge lower fees than a traditional buyout fund. Private equity funds have long been known for their 2 and 20 fee structure, charging investors a 2% management fee and 20% carry. The lower fee at the co-investment fund level, with generally no fees for the underlying co-investments, makes co-investment funds more attractive from a fee perspective than single manager funds. Fund of funds will generally have a double layer of fees, one paid to the fund of funds manager and then another paid to the private equity funds it invests in. Co-investments are also more capital efficient. What this means is that when you invest, your money is put to work faster. Co-investment managers and a single manager fund generally deploy capital at the same pace, although co-investment managers can effectively manage the investment pace as they can allocate capital in portfolio companies across different lead sponsors, whereas the single manager is limited to deals that they themselves lead. When you invest in a private equity fund of funds, the manager commits to underlying private equity funds, and those funds invest directly in portfolio companies. While this may be less capital efficient, you gain greater diversification. A co-investment fund presents an attractive risk-adjusted return when compared to a traditional buyout fund, given the level of diversification. Further, accessing co-investments through a fund has the potential benefit of reducing risk due to the extra layer of due diligence required by the co-investment manager. The key takeaway here isn't that one investment is better than the other, but rather that each has its role to play in a portfolio depending on your investment objectives. We have seen many portfolios that incorporate all these investments, as the varying characteristics and risk-return profile can make them good complements. Now that I have covered the potential benefits of co-investments and some of the key considerations, I would like to focus on the role co-investments can play in a private equity portfolio. We consider co-investment as part of a client's buyout sleeve. Many allocators even call co-investments direct buyout deals, as they view them as synonymous. At a high level, we believe co-investments to be beneficial to the overall risk-return profile of a private equity portfolio. By providing access to leading private equity GPs and a larger opportunity set, co-investments can produce alpha, particularly when combined with good manager selection and co-investing's lower fees. We have walked you through some of the benefits and risks of co-investing, as well as how co-investments can fit into a portfolio, and hopefully have given you some good food for thought. I know we have shared a lot of information, so as they say, if you only remember a few things about what we shared, here are the essentials that you need to know about co-investments. 1. For those accessing co-investments through a co-investment fund from a private equity manager, they have the potential to improve the overall portfolio risk-return profile through lower fees and greater diversification. 2, for those accessing co-investments directly, they enable flexible, tactical portfolio management or the ability to make more precise allocations and nimble enough to take advantage of certain market opportunities, as well as mitigate the J-curve through faster deployment and lower fees. And finally, for all, they also provide more in-depth insight into the GP and the investment from a due diligence perspective. All these benefits make co-investments incredibly valuable to include in a core private equity allocation.
We're now moving to the Elevate portion of our co-investment program, where we hope to continue to take your knowledge of co-investing to the next level. In our next module, we'll show you how an actual co-investment deal gets done from start to finish. We'll walk you through the various stages of a transaction and the underlying steps involved in each. It's my pleasure to turn it over to David Morse, Managing Director and Co-Head of Global Private Equity Co-Investments, who will guide you through the process of sourcing and completing a deal. David will give you a clearer sense of the intricately connected web that is co-investing, with particular emphasis on the expertise and capabilities required to invest successfully.
Hi, I'm David Morse, co-head of Neuberger Berman's Global Private Equity Co-Investment Team. We truly appreciate your interest in co-investments and hope you find the information we're sharing in this module to be helpful and applicable to what you and your clients are hoping to achieve. Our team has been sourcing, conducting due diligence, and executing co-investments since 2006. And we have completed hundreds of co-investment transactions alongside a wide variety of lead private equity sponsors. Globally, we have dedicated professionals from the investment, legal, operational due diligence, and finance teams that are focused on co-investments. As you will see throughout this module, there are many moving parts, skills, and experiences required to successfully complete co-investment transactions. I'll first provide an overview of our process, and then I'll do a deep dive into how we actually conduct due diligence on each co-investment opportunity. Let's start with a detailed look at the key junctures across the timeline of a deal, from the very beginning when the opportunity is sourced and offered, to, ideally, a successful portfolio company exit. There are 4 phases of deal execution that we will cover. Origination, which is all about sourcing strategy and gaining consistent access to high-quality deal flow. Due diligence or selection. This stage focuses on researching the co-investment opportunity, which is done on 3 levels. On the lead sponsor to better understand its investment strengths, value creation, approach, and performance history. On the company itself and its industry. And then finally, the specifics of the transaction itself. Closing. The closing stage is the period in which the various below-the-surface details of co-investment arrangement, including terms, fees, and governance, are negotiated and settled. Monitoring. From the closing point on, the focus shifts to continuous monitoring leading up to exit. Limited partners, or LPs, involvement at this stage is typically established in the governance terms. Let's dig into each of these a bit more. The ability to originate co-investment opportunities is extremely crucial. The more opportunities you can see, the more selective you can be, and the more confidence you can have that you are truly selecting attractive, risk-adjusted opportunities. In the world of co-investing, lead sponsors or the private equity firms leading the co-investment transaction can choose who they want to work with, and it can be as few or as many co-investors as they would like. To be successful in co-investing, it is important to have robust relationships with numerous lead sponsors to ensure that you can generate enough deal flow to properly execute a diversified co-investment program. These relationships need to be strong enough that if you decline a co-investment opportunity, the lead sponsor will still come back to you for future opportunities. If you don't have the relationship, it's worth considering working with a private equity manager who does, who can execute co-investments on your behalf. This is what we often refer to as a co-investment manager. A co-investment manager should have strong relationships with multiple general partners, known as GPs, globally to broaden the universe of available opportunities and strengthen diversification for its end investors. In this case, the process of sourcing new co-investment opportunities is similar to the process of buying a new home and hiring a realtor. The realtor will understand the market better and have more connections to find homes that have certain features, such as attractive characteristics or better valued homes. The realtor is the co-investment manager in this example. They have the connections to get you access to strong deal flow and the experience to help you select the right co-investments. LPs researching co-investment managers to potentially work with should make sourcing a focal point and understand the manager's capabilities as well as possible. One way to determine if a co-investment manager has a strong network, or to determine whether or not you can source co-investments yourselves, is to assess the number of primary relationships, which is one avenue to gain access to co-investments. Another is to evaluate the number of advisory board seats the manager holds, which can indicate the strength of a relationship with the lead sponsor. And then last but not least is looking closely at the global reach and relationships the investment team has. Managers that have large, geographically dispersed investment teams generally have a stronger ability than others to source co-investment deal flow. Continuing with the home buying metaphor, the next phase, evaluation, is similar to having a detailed inspection done before the official purchase. This helps buyers to get to know the home better and obtain a true assessment of its value. Likewise, with co-investing, investors need specialized research expertise to properly analyze an investment opportunity. When conducting diligence on a co-investment, we believe there are 3 areas that need to be analyzed prior to deciding whether or not to invest. First is the due diligence on the company itself, and the key question to answer here is whether it is a good business with opportunity for substantial growth. The second area for due diligence is the private equity firm or lead sponsor that will be owning the company and implementing any changes to it. The key question here is whether the GP is the right owner of this company and if they have the experience to implement the changes that will increase the value of the company. And finally, one needs to diligence the transaction itself. Here, the question we are looking to answer is, given the price and structure of the deal, does this represent an attractive risk-adjusted return? So starting with the company, what are the areas we look at to determine if this is a healthy, growing business? First, we look at the industry of the company. Does the industry represent an area that is growing or have the opportunity to continue to evolve? For example, you can buy the best company at selling DVDs, but if the world is moving toward online streaming, then no matter how great the company is, it doesn't represent an area that will be able to survive. Another thing to consider is market cyclicality. How sensitive is the industry and ultimately the company going to be to the business cycle? How much of it can be in our control? If very little, how adaptive is the company to changes and market cycles? Then taking diligence one step deeper, what is the company's position in the industry? Is it a market leader? A company that is a market leader may be more stable, but can it grow? Same thing with a company that may not be a market leader. Can it become one? Or is it limited by various barriers that may be out of its control? How competitive is the landscape for the company? Finally, you need to look at the company itself. Specific areas of diligence will vary by industry and situation. But generally, you would want to look at the business model, strategic initiatives, growth drivers, supplier-customer concentration, historical financial performance, and management team quality. When we're evaluating the lead sponsor, we generally focus on their expertise in a specific sector or strategy, We want to work with lead sponsors that have expertise in the company's industry. Investment track record. How have they done with similar investments in the past? Ability to execute on the investment thesis. What is their plan to create value in the underlying portfolio company, and do they have the expertise and resources to actually carry out that plan? And last, their alignment of interests. For example, are the interests of the lead sponsor and the co-investor aligned? I will talk more about this in a moment. The final step is to diligence the actual transaction itself. Examples of diligence areas include how the transaction is set up, what the proceeds or co-investment capital will be used for, the capital structure, entry valuation, or put more simply, the price of the investment, free cash flow profile, exit strategy, and minority protections. Because many co-investors are minority investors, it is important to ensure the co-investors' interests are aligned with the lead sponsor. Things to look out for include making sure that you are investing in the same investment security, that the capital being put in by the lead sponsor is significant and material, the terms and economics are similar between the lead sponsor and the co-investors, and that there are minority protections in place, among other elements. Also crucial to due diligence is the exit strategy. A co-investor should evaluate the exit plan for the company. For example, is it going to be a sale to a strategic or financial investor, a public offering, or are there recapitalization opportunities? Understanding the potential buyer universe and timing for exit are important elements of the due diligence process. What makes for a good investment? At Neuberger Berman, there are some common characteristics that we look for in each investment that we make. These include a sound business model with sustainable competitive advantages and low sensitivity to cyclicality, multiple and clear options for value creation through organic business expansion, operational efficiencies, acquisitions, or other actions, a reasonable investment valuation, a prudent capital structure, an experienced lead sponsor strongly aligned with the specific investment opportunity, clear exit paths with potential for early monetization, and an asymmetric risk-return profile with potential for significant upside while preserving a downside protection. Now comes the closing. When you buy a house, this is that day when you sign the stack of papers finalizing terms, rates, disclosures, and payments. In co-investing, the closing stage commences as soon as the due diligence is complete, and the LP and GP decide to move forward together on the opportunity. Many moving parts converge in this phase, and specialized expertise in areas such as legal, tax, finance, and operations all play valuable roles, getting the deal over the finish line and ensuring all the right components are put into place. Some of the key steps involved in the closing process, which can vary in length of time, include negotiating terms, reviewing tax structures and implications, memorializing governance responsibilities, and reviewing relevant legal documents. After the closing period is complete, the remainder of the timeline focuses on monitoring the progress of the investment. This can include having regular dialogue with the GP, participating on advisory boards, and being made aware of material updates. When it comes to monitoring, a co-investor doesn't have much control over the management of the company. This is why getting to know the lead sponsor well and ensuring alignment of interest during the due diligence phase is so critical. We have shared a lot of information with you, and I hope our team's insights have resonated. Let's summarize. First, there are 3 core areas that require diligence, including the target company. Does it have the potential to be a strong and growing business? The lead sponsor or GP. Can this partner implement the level of change necessary to consistently create value and ultimately generate returns? The transaction itself. Given the price, capital structure, and characteristics of the investment, does this opportunity represent an attractive risk-adjusted return? Second, conducting diligence on a co-investment is resource-intensive. It requires having relationships and an extensive network to source opportunities, readily available capital, the ability to make efficient decisions after a thorough due diligence process, and the necessary expertise to structure deals, ensure alignment of interests, and to monitor the investment. And lastly, if you seek to work with a co-investment manager to help you, be sure that you find the right partner. That too is crucial in achieving successful co-investment outcomes.
As we wrap up this course, hopefully you're connecting the dots and starting to understand the world of co-investing and how it works. In our next module, we will focus on empowering you by showing you how to take your co-investment knowledge and apply it in ways that can benefit yours and your clients' portfolios. In doing so, we'll first focus on explaining the different ways you can access co-investments. The vehicle you choose to access co-investments is important. There's different ways to get you to your destination, and in this section, we'll walk you through the investment vehicles and highlight their key differences. To kick us off, I'm pleased to introduce Mike Smith, a managing director on the NB Private Markets investment team.
Hello, and thank you for your interest in co-investing. My name is Mike Smith, and I am a managing director on Neuberger Berman's Private Markets co-investment team. I appreciate the opportunity to highlight the various ways you and your clients can access and gain exposure to co-investments. Co-investments generally offer investors an exciting opportunity to work directly with lead sponsors and invest alongside them in their underlying portfolio companies. However, they are complex investments with different associated risks than a diversified buyout portfolio. To maximize the benefits co-invest can deliver within a portfolio, we believe success boils down to three important characteristics. First, having ongoing access to top-tier general partner or GPs across geographies, industries, and sectors. This is essential to accessing robust, high-quality deal flow. Second is having the dedicated execution expertise and internal structure in place to enable strong due diligence capabilities and streamlined decision-making. And last, being able to add value to the lead sponsor. For example, serving as lead co-investor, becoming a reliable source of capital, performing supplementary research, or helping with underwriting transactions that are on accelerated timelines are just a few ways to become a preferred co-investor and gain greater access to opportunities. Investors that can be good at all three are able to invest directly into co-investments, or in other words, work directly with lead sponsors to invest alongside them in their underlying private companies. However, this can be a tall order for some, and as the saying goes, it's important to realize that you don't know what you don't know. For those without these capabilities, it may be best to work with a co-investment manager that can execute co-investments on your behalf. Even if you opt to work with a co-investment manager, there are still a variety of ways you can access co-investments. Our goal is to empower you so you can make the best decision possible on how you and your clients should access co-investments based on your specific needs and objectives. So let's jump in. Ground zero is understanding the three primary ways to execute co-investments, which are outsourced through a private equity fund that invests in co-investments. This option has multiple investment structures to choose from, depending on investors' specific investment needs and objectives. The second way is in-house, but in partnership with a private equity manager. And last, in-house, but solo, with no external partner involved. The latter two tend to be used by institutional investors. Individuals and institutions will both outsource. Each of these access strategies has distinct characteristics in terms of how they're structured, their impact on diversification, the fees they charge, overall ease of access, and the level of experience and expertise required from the investor. Let's start with the first option, which is investing in a co-investment fund where the manager invests on your behalf. Co-investment fund managers tend to work with a variety of lead sponsors, allowing the fund to be diversified across industry, geography, company size, and lead sponsor. One of the common misconceptions is that a co-investment fund is like a fund of funds. This, in fact, is not true. In a fund of funds, one invests in a fund managed by a private equity firm. Let's say Firm A. Firm A's fund invests in other private equity funds managed by a variety of firms, which invest into private companies. A fund-of-fund structure might be beneficial to an investor who is seeking to get a broad, diversified exposure to a number of underlying lead sponsors and their portfolios. In contrast, a focused co-investment fund managed by Firm A removes a layer since it invests directly in private companies alongside other private equity firms, also called lead sponsors, who are then responsible for managing the underlying portfolio companies. In doing so, they seek to implement value creation plans that will in turn generate returns for the end investors. In these funds, the co-investment manager has full discretion on where, when, and with whom the fund invests. As a co-investment fund investor, you are relying on that manager's deal flow, their due diligence expertise, and their ability to select the right investments and to monitor them post-investment. As such, when you are investing in a co-investment fund through a traditional private equity fund structure, it is extremely important to do your due diligence to make sure you're working with a selective co-investment manager with access to high-quality deal flow. Many co-investment funds come in the form of traditional private equity funds where capital is drawn as investments into private companies are made, typically known as the investment period. These funds have a finite time period of between 6 and 12 years during which they must invest and then sell the underlying portfolio companies depending on the fund. For example, a 4-year investment period in a 10-year term is generally reflective of most co-investment funds. However, a fund option that has a 1-year investment period and 6-year term may be attractive for short-term minded investors seeking greater flexibility in allocations. Liquidity in these portfolios is limited, mainly because of the time it takes for lead sponsors to enlist investors, perform due diligence, and put their value creation strategies to work within the underlying portfolio companies. These vehicles were historically designed for institutional investors, so generally have higher investment minimums and stricter eligibility requirements. Reporting and valuations for these vehicles are generally quarterly. A final note here. In order to continue to allocate consistently to co-investments, you would need to invest in subsequent funds that are raised every couple of years. Another co-investment option is to outsource to an external co-investment manager through an evergreen or open-ended fund rather than deploying a traditional private equity fund. At a high level, open-ended private equity funds can mitigate certain challenges associated with traditional drawdown funds, mainly involving liquidity risk. Drawdown funds require investors to make commitments up front, and then the lead sponsor calls investors' capital periodically over time as they identify investments. Over time, as realizations occur, proceeds are distributed back to the investors. Open-ended funds allow investors to buy into diversified pools of assets at fair value and provide flexibility, and then investors can make additional investments or withdraw from the fund at regular intervals, subject to available liquidity. Open-ended funds typically reinvest any realizations from existing investments into new investments. This creates a perpetual investment cycle that allows investors to maintain exposure over time without capital calls, distributions, or the need to make new commitments. Together, these features can create a more adaptable and operationally simple approach to private equity investing. Most open-ended vehicles were designed with individuals in mind. They were tailored to meet the needs and investment objectives of individual investors, and thus generally have lower minimums and eligibility requirements. However, it would be wrong to assume that open-ended funds are only for individuals. We have found that institutions have also utilized these vehicles to take advantage of other features, such as the ability to gain access to an existing portfolio of investments right away. Open-ended vehicles are generally more regulated and will have more frequent reporting requirements. In most cases, this happens monthly, meaning NAV pricing will also be available on a more frequent basis compared to traditional private equity funds. It is important to note that although the structuring and mechanics of traditional private equity funds and open-ended funds are different, they both involve an active value creation process in the underlying investments and are managed not against a benchmark but on a cash return basis. Also, with both, it is important to do your homework on the private equity firm managing these funds to ensure that they are able to achieve your investment objectives when it comes to co-investments. For investors considering an open-ended co-investment fund, they must consider the abilities of the manager and whether they possess the unique skill sets required to manage open-ended funds. Here are several things we look for. First and foremost, we believe that managers should offer the same institutional quality investment opportunities in their open-ended funds that they provide through their traditional drawdown funds or custom mandates for a given strategy. Secondly, managers need access to a large enough opportunity set of investments that allow the open-ended fund to maintain its target deployment level. Simply put, the fund must stay invested in private equity to generate private equity rates of return. This makes strong deal flow critical to proper fund management. Open-ended funds must manage regular inflows and outflows and be prepared to deploy capital whenever it comes in. And last, does the manager have the operational chops? Open-ended private equity funds are more operationally complex and require a broader range of skills than managing traditional drawdown funds. The manager is responsible for reinvestment decisions and liquidity management and should have experience in managing liquid assets as well as private assets. Let's shift gears now and get into the decision-making process. How do you decide which vehicle is best for you? We dive deeper into this in our portfolio construction module, but it's important to consider your own unique investment goals, limitations, and considerations in choosing the optimal vehicle. For example, individual investors often prefer open-ended vehicles due to their lower eligibility requirements and minimums and greater operational ease, both of which make the asset class more accessible to them. On the other end of the spectrum, there may be an institutional investor with a robust private equity network and vast resources that are able to invest directly into co-investments. The next option I'd like to discuss with you is a hybrid approach, where the limited partner, or LP, performs some of the research and management in-house, but partners with an external GP that provides more specialized skills and resources. This is a popular choice for institutional LPs that have some, but not all of the skills necessary to participate across the full deal cycle, but who still want to maximize and supplement their abilities to achieve positive results. In this arrangement, the external partner typically has two key jobs. One, to execute on co-investment deal flow and keep the pipeline stocked. And secondly, to help the co-investor get exposure to additional co-investments. The co-investor typically has a small team that dedicates a portion of its time to co-investments. These types of mandates can be achieved through custom strategic partnerships. For those institutional investors with high co-investing ambitions, deep due diligence capabilities, and a large bench of qualified investment professionals, executing co-investments directly and on their own is an option. Larger, more sophisticated LPs with deep resources and a desire to become more active co-investors tend to lean towards this approach because it allows them to see the inner workings of a deal and the necessary steps up close. For companies that take this route, it may require hiring new talent with specialized skills focused on areas such as investment, legal, and tax and accounting. Going solo also means having extensive operational and infrastructure support, as well as the ability to source and monitor co-investments globally. Whichever access strategy you choose, one common denominator is that you and your clients have the ability to see more diverse, high-quality deal flow by being a reliable, productive, value-add co-investment partner. This frequently opens the door not only to further co-investment opportunities, but to other areas of investments. We thought we would close out this section of the module with a checklist of factors that we believe should be on every investor's list, whether they work through a manager or on their own. The first item, agile decision-making. Speed is a game changer in co-investing. These opportunities typically have tight turnaround times, and the pressure can really get dialed up at key junctures, such as when the LP needs to make a very fast decision. Co-investors with governance structures in place that enable important decisions to be made quickly will be valued. For those that don't, their phones will stop ringing. Second, managers need to have dedicated, highly capable sourcing and monitoring capabilities. We've described how complex co-investing can be. Executing transactions demands significant resources, from sourcing to evaluating to closing to monitoring and exiting. Investors will want to do a full audit on the managers they consider. And third, specialized legal and structuring expertise. When we say deal teams, we're not just talking about analysts and managers. We're also talking about the attorneys, tax advisors, and other true specialists without whom our co-investment deals simply would not get done. Having deep legal and structuring expertise involved is critical at certain points in the deal timeline, particularly at the beginning and the end. I've given you a lot of information in a short period of time, so let me leave you with some of the key takeaways when it comes to accessing co-investments. First, there are generally 4 distinct methods for accessing co-investments, and choosing the right one depends on each investor's needs, objectives, and risk tolerance. There is the traditional drawdown co-investment fund with terms of anywhere from 6 to 12 years. There are evergreen fund structures which offer lower minimums, have more flexible eligibility requirements, offer ease of use, and importantly, provide periodic liquidity. Investors can also gain access through a custom account by partnering with private equity managers to help execute deals. And last, investors with the full suite of capabilities, resources, and capital can access co-investments directly on their own. And the second takeaway, choosing the right access strategy is critical to success, and so is choosing the right manager if you choose to go that route. Do your homework to truly understand whether a manager has what it takes to accomplish what you need to achieve, and do not settle for less. I hope we gave you some good information as you consider your own strategy for gaining entry into the wonderful world of co-investing.
As we wrap up this module on private equity co-investments, we hope you feel empowered to incorporate this strategy into your clients' portfolios and that you leave with a deeper understanding of how to effectively leverage private equity co-investments. At Neuberger Berman, we're committed to providing you with the knowledge and tools necessary to help your clients achieve their financial goals. If you have any further questions or need additional resources, please don't hesitate to reach out. We're here to help you every step of the way. Thank you once again, and we look forward to seeing you in our future modules.